How often should you trade? What's too often? And can you be objective when deciding when to buy and sell? Well, in this video, we'll find out. I'm Anthony, and as always, we're talking money. I'm going to hold my hands up here and say this is going to be a very difficult one to answer. Perhaps I should have chosen a different question. But anyway, I will attempt to answer it. And if you stay right to the end, I'll give you my criteria as to when to sell a stock. Okay, right then. The question of how often is too often is perhaps a little easier to address first. Every time you make a trade, you're essentially sacrificing a little bit in terms of commission, tax, and spread. Even on free commission brokers, you still have to pay stamp duty, and especially on free brokers, your spreads, that's the difference between buying and selling prices, is going to be larger. Frequent trading may make you look and feel like those slick day traders that are made famous in various Hollywood films, but being the next Wolf of Wall Street isn't done on the back of scalping small profits. Instead, your decision as to when to buy and when to sell should be determined by investing rules. Now, I'm as guilty as the next person to set rules and then probably break them when my nerve fails. But sensible rules would be to buy when the shares meet your criteria. I'll put up on the link up here the video that I did on how I choose my criteria, and then sell them when the stocks either fail to meet those criteria or the market tells you that you're wrong. And the best way that the market is telling you that you're wrong is that the price has fallen so far that you are sacrificing any profits or extending your losses too far. John Maynard Keynes, the famous economist, said that the market may be irrational, but it can remain irrational far longer than you can remain solvent. And how true that is. If you want an example of how this philosophy of buying when meeting criteria and selling when they don't, you need look no further than perhaps one of the world's best investors in the world, namely Warren Buffett. He's famous for his buy and hold strategy, often holding shares for decades. However, if a mistake is made, like his purchase of Tesco shares some years ago, he admitted his error and sold down his stake, taking a loss in the process. But as we're on the subject of Warren Buffett for a moment, some would argue that his very low rate of trading would call into question his status of being one of the greatest investors in the world. Consider some high frequency or day traders that trade tens or hundreds of times a day. They may make 100% compared to Buffett's 20%. The huge difference, though, is the scale and the compounding effect that Einstein called the eighth wonder of the world, and who would argue with him? Buffett's slow turnover of stocks, which is partly due to the size of his stakes in some of the world's largest companies, is both a blessing and a curse. He can't exit his trades as quickly as you or me, but this means that he's committed for the long term and reaps the benefit of those compounding dividend checks that come in year after year. His scale forces him to take very long positions, but in doing so, his overall returns from those very sizable dividend checks over 50 years has built him a $96 billion fortune. Trading too often robs you of the opportunity to compound dividends over time. And as you can see from the graph here, the majority of stock market returns are made from reinvesting those dividends. So from this little scenario, my personal stance on the question of how often should we trade is that in an ideal scenario, an ideal world, we should trade the share just once, buy and hold forever. In real life, this probably isn't the case. I'll demonstrate with a little example for you. If the yield on the share is, say, 5% and we've invested £1,000 and it falls to £800, a 20% loss, that may ordinarily kick out our stop loss limit. It would normally take 4 years in dividends, actually a little bit less if we take into account compounding, to recover that loss, after which, in theory, we could be sitting on a capital loss but still have a positive total return on our investment. Now let's make this a little bit more interesting. If the yield was 10%, we would only have to wait 2 years before a positive return. Now if we'd sold our investment as soon as it hit our 20% stop loss limit, we'd have to find another investment that would have to increase not by 20% but 25% until we were back up to our initial £1,000. And it would also have to yield the same amount. So the question to ask yourself is this: do I stay with the initial investment that's reduced by 20%, but that loss will be recovered in a time frame dictated by its dividend yield? Or do I sell now and try and find a better investment that will increase by 25% in capital while also yielding the same? To put even more simply, is it riskier to stick with your current investment knowing that a positive total return is on its way in time, or to search for an alternative stock that you've yet to invest in? You see, it's not quite as straightforward as it may seem. You can see now why the buy and hold strategy that people like Warren Buffett go by is so attractive. If you're in this for the long term, if your time frame is say 40 years, you can in theory make a 100% capital loss but still show a positive return by the end of it thanks to those reinvested dividend checks. So we still haven't answered the question, how often should you trade? But trading simply because a stock is currently down is not necessarily a reason to sell if the stock is yielding a dividend. This argument wouldn't stack up at all if you're trading in non-yielding stocks or assets like gold or cryptocurrencies. So park that idea for the moment. The next thing I want to consider is how much each trade is going to cost you. Even with free brokers, trading is not free. You have stamp duty and the spread between the buying and the selling price. These trading costs are not insignificant, but they are subtle, especially the spreads. If the difference between the buying and the selling price is 100 pence to buy and 102 pence to sell, or 2%, you need to trade only 50 times or once a week, and you've then completely eroded the total value of one of those trades. Alternatively, if the shares you trade are yielding 4% per annum, if the spread on it is 2% to buy and 2% to sell, then simply selling a share and buying another one has cost you a year's worth of dividend payments. And remember, it's those reinvested dividends that provide the bulk of the stock market return. Hopefully you can see that asking how often you should trade is the wrong question. The question really should be replaced, what justifies a trade? Okay, I'm going to tell you what I do, and you're very welcome to put in the comments section below what you think, and if you do things differently, I'd just be really interested how other people do it. But I enter a buy trade when my stock meets my buying criteria, and my criteria are covered in some detail in the video that I'll put up here. By having a set of criteria for stocks to justify buying it means that your decisions are rational and not emotional. Now, deciding when to sell is actually much harder. You need criteria even more here, because if you're selling at a loss, then you're fighting a psychological hurdle. No one wants to sell at a loss after all. I know I certainly don't. And normally, setting a simple stop loss limit will provide you that rational criteria. I generally set mine around about 20%, and this can be a trailing stop loss as well. But going back to what we said earlier about how dividends quite quickly recover a capital loss and faster if the dividend is higher. So here is my suggested rational stop loss selling criteria that takes into account dividend yield and time frames. It's really simple. So you take your investing timescale. It could be 5 years, 10 years, even 40 years. And this might be the time that you retire or need the portfolio for another reason. Then take the dividend yield on the stock in question. Let's say it's 5%. Take off 2.5% inflation. You've got to take a view on inflation. You can adjust it over time if inflation takes off or is suppressed for any reason. The result, 5% minus 2.5%, is 2.5%. So with that, you just multiply it by the time frame. So we get our yield and time adjusted stop loss. So to give you an example, 2.5% times 5 years is 12.5% stop loss. 2.5% times 10 years, which is 25%, or 2.5% times 40 years is 100% stop loss. Clearly, I'm not suggesting that anybody sticks with a share that's approaching 100% capital losses. After all, it's unlikely that that stock is going to be paying the same amount of dividends as it did before if it's tanked that much. But the general principle applies that the higher the dividend, you can lower your stop losses a bit. And also, if your time frames are longer, you can lower your stop losses as well. Now, hopefully that is a sound theory, but please put in the comments what your thoughts are as well. I'll be really interested to read them. Essentially, you don't have to have the same stop losses as a blanket policy across all your stocks. But we simply do not want to make a capital loss if possible. And that's what Warren Buffett said was the first rule of investing: don't lose capital. Yeah, right, it's easier said than done, isn't it? So if you're investing for 10 years, your stop loss limit should be around 25%. Or more if the time frames are longer, less if the time frames are shorter. Also, if your yields are different, then so too should your stop loss limits. Higher the yield tends to lead to higher stop loss limits. So you can see a 5-year time frame limit might be a little bit too short for investing in risk assets like shares. If this is your time frame, then index trackers are probably better as volatility is lower and yields are a little bit more secure and less likely to hit those stop loss limits. So there you go. How often should you trade? As often as your rational criteria tell you. And this may be very infrequently indeed. If you want to jump onto the video on how I choose my buying criteria, then I'll put it up on the screen right now. Anyway, I hope you've enjoyed the video. Hit that subscribe button if you had and the like button. I'm Anthony. As always, we're talking money, and I'll catch you in the next video. But until then, bye for now. Thanks for watching.